Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
You just inherited $1 million. How would you invest it? Would you buy stocks? Would you buy bonds? Would you buy gold, real estate? How would you invest that $1 million? Or if you have a 401k, IRA, 403b, whatever, the investments that you currently have, how are you currently investing them? Markets at our all-time highs, interest rates all-time lows. What do? Stick around. We're going to weed through the mess and tell you how you should properly invest. Welcome to another episode of Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner and president of Pure Financial Advisors, one of the largest fee-only financial planning firms here in Southern California. As always, I'm with my partner, Big Al Clopine. He's the CPA. He's the man, the brains behind the scenes. So let's dive in. Let's get on what's on my mind today. Big questions right now. Markets all-time highs. How do I invest my money? What I want to give you today is a gift from us, Pure Financial Advisors. It's think, act, and invest like Warren Buffett. If you're not going to take our advice, at least take advice from probably the smartest investor of our time. Think, act, and invest like Warren Buffett. You can go to yourmoneyyourwealth.com, click on the icon, and get your free book. It'll take you an hour to read, and once you get done with this book, you will be a better investor. Or if you stick around for the next half hour, you will be a better investor. Like I said, don't take my word for it. This is a clip from Warren Buffett. Let's go to that to see what he says.
The biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month, and for whatever reason people give you.
So here's a problem, right? Look at Warren Buffett. Everyone's looking at the next hot stock. What's the best investment that I can get into? Should I buy this individual company? Because I have a certain belief that I believe it's going to go up. That's the problem with most people in their investment strategies. They think that they might know more than the overall markets. Do not invest that way. And Al, that's probably one of the biggest problems that we see. So let's go to Big Al. So when you're looking at investing, it's like, okay, Al, what should I get into? What's the best stock? What's the best sector? That's probably one of the worst decisions that people can make when they're managing their own money.
Well, it is, Joe, and that's why we're going to spend some time on this show talking about how to invest correctly, how really everybody should invest. And well, there's going to be really 5 main topics that we're going to cover today. And I'm going to start with number 1, which is globally diversification. Diversifying globally, which means you want to have assets around the world, not just in the United States. And you don't want 1 or 2 or 3 or 4 companies. You want many companies, perhaps in an index fund, exchange-traded fund, inexpensive type funds that hold thousands of stocks, so you're diversified globally. The next thing you want to consider is you don't just want one asset class like the S&P 500. You want several asset classes. We'll get into what that means, but to have a well-diversified portfolio, you want to have many different investments. You will need to tax manage, and that simply means pay attention to the taxes inside your investments. Some investments are more tax efficient. Some types of accounts have different tax treatments because it's not really what you make, it's what you keep. Make sure that you rebalance your portfolios periodically to make sure that you have the right assets for you. And then finally, given a choice, pick low-cost investments rather than expensive ones. Did you know certain investments are less expensive than others? And Joe, these 5 things, I mean, in some ways it sounds kind of basic, but this is what you need to follow to be able to successfully invest over your lifetime.
Well, investing should be basic. It should be easy.
Right.
But Wall Street wants to make you believe that you have to have a crystal ball to figure out exactly what you need to do to make some money. The markets themselves create a ton of wealth. But you want to make sure that you keep your investment strategy very simple, that you understand the strategy. And there's some mistakes that a lot of you are making, such as you're not investing globally. When we look at portfolios, most of people's portfolios are heavily weighted in U.S. domestic growth stocks. If you look at the market capitalization across the world, right, the U.S. right, is only a small component. You're missing 60% of the game if you look at market capitalization, because if you're not investing globally, or if you're not investing internationally, you're making a big mistake. You're leaving chips on the table, so to speak.
Yeah, and the other thing too is if you just kind of fast forward to 2050, the estimate is about 17% of global capitalization is really going to be in the U.S. and the rest is internationally. So you have to realize that it's not just the United States only. You want to have exposure to all markets. And why? It's because different markets go up and down at different times. They're not exactly correlated, which means that when you have certain asset classes domestically, those similar type of asset classes globally may be going in different directions, and you want that because it reduces the risk in your portfolio.
Well, yeah, here's the problem, right? If I have all my money sitting in large company growth stocks here domestically, if the market tanks, all of your portfolio is going to blow up. So you want to make sure that you have negatively correlated asset classes. In most cases, if you take a look, when international companies do well, domestic companies do poorly, and vice versa. So that's going to help you on the downside. If you have everything bet on one asset class, such as domestic stocks, that when the S&P per se drops 10, 20, 30%, what's going to happen to your overall portfolio? So you want to make sure that you have the diversification necessary. And the first step of this is to say, all right, well, do I have any of my portfolio divested or invested internationally? So that's one of the key components of building the overall portfolio.
Well, it is, and I think the next thing is really how should you invest? I mean, there are stocks, there are bonds, there's mutual funds, there's real estate, there's natural resources like gold, silver, and oil and gas, that sort of thing. You want to have components of each of these. And sometimes people load up all in stocks, and then they want to get out of the market because they feel like it's too risky, and then they get just into bonds. You want to have a mixture of each of those. You want to have components of each, both domestically and internationally.
Right. So if you, real simply, here's what you need to do. So when you're looking at investing your money, you want your money to grow. And so there's two things that you can do. You can purchase an asset, or you can lend your money out. If I'm purchasing an asset, that could be a fractional ownership of an organization, such as common stock. I could buy an organization. I could be the CEO of my own company. I could also look at buying real estate. I could buy precious metals, easy for me to say, or natural resources. So that's me purchasing an asset. So then I'm having my capital purchasing an asset, hopefully that organization does well, and then I reap their profits. Another way I can do it is I can lend my money out. All organizations want to grow. They do it in two ways. They give you a piece of their company, or they're going to take a loan. So you're going to act as the lender. Here, XYZ Corporation, here's $100,000. They're going to take that capital, and they're going to try to utilize that the best they can to help their company's profits grow. What you're going to receive in return as an investor is an interest rate, such as 2%, 3%, 5%, whatever the note is. So it's just like a loan, or if you're buying a CD, you're giving your money to the bank in exchange of a certain interest rate. They're utilizing that capital for their purposes. Then at the end of the term of the loan, you get your money back. So if it's 1 year, 3 year, 5 years, or 30 years, depending on the type of bond that you purchase, that's what's going to determine your interest rate. If you think about it, if you give an organization your money for 30 years, there's a lot of risk associated with that, so you should demand a higher interest rate. If you're looking at, hey, if I'm only going to give it to them for 5 years, well, there's less risk associated with that, so you'll receive a lower interest rate. So how you build your wealth and how you build your portfolio is that you buy an asset or you lend your money out. It's as simple as that. When we get back from the break, we're going to dive in a little bit more and get more complex to say, all right, well, if I'm investing my money in organizations, what type should I buy? Smaller companies, large companies, value growth. There's a smorgasbord of information out there, and there's a lot of things that you want to make sure that you utilize to increase your overall expected return, because when markets correct, you don't want to be on the bottom side of that. Stick around. Don't go anywhere. You're watching Your Money, Your Wealth.
Check it. Click. I just bought stock. You just saw me buy stock. No big deal. I mean, you know, if I can do it, You can do it. Whoa.
So you don't want to buy stocks like that, right? So that,
No.
I mean, here's what it is. Here's what the advertisings are, is that, okay, well, buying stocks are easy. A baby can do it. They can do the research, and then they just click and point, and then next thing you know, you got a diversified portfolio. That is the last thing that you want to do with your money, is that, okay, well, what stocks do you buy, right?
Yeah, well, I was just thinking, I don't remember my kids buying stocks at that age, but I do remember the spit up very well.
Really?
That's real.
Well, yeah, they probably bought the wrong stock. I mean,
maybe
it's
that was
right? He saw the wrong stock, and then you saw it plummet, and the next thing you know, he puked all over the,
Maybe that's why, huh?
Yeah, that could be. Hey, do this right, okay? You don't want to gamble your overall life savings away. Get the book. What we're doing is a free financial assessment today, and also we're giving away Warren Buffett. Play the winner's game. Think, act, and invest like Warren Buffett. If you want to invest like Warren Buffett, one of the smartest investors of all time, get your hands on this book. We're giving it to you for free. If you're curious on what you should be doing with your money right now, when markets are at all-time highs, interest rates are pretty much at all-time lows, now is the time to act. Because if the market corrects, what's going to happen to your overall retirement if the market goes down 20, 30%? It will happen. We just don't know when. There's always going to be a correction. Markets hit all-time highs, they correct and hit all-time highs again. What is your strategy to make sure that you can protect the wealth that you built up? Get the book, or you can always call our number at 888-994-6257. That's 888-994-6257. Let's go to the true-false question. Let's see how you did here.
All right, here we go. Index funds and ETFs tend to have much lower internal expenses than retail mutual funds, thereby allowing you to keep more of your profits.
Yeah, that's absolutely true. So when you take a look at what type of investment that you purchase, you can buy a retail mutual fund, of course. They have a little bit higher internal costs. Or you can buy an index fund or an exchange-traded fund where you're buying the entire index, or you're buying all those stocks in that particular category. There's not a lot of trading, there's not a lot of turnover, and there's no active manager that you have to pay. And if you take a look at the statistics, most active management funds don't beat the index anyway, so don't play that loser's game, play the winner's game. But then it's what type of stocks that you purchase. How do you construct a portfolio? How much money do you have in stocks versus bonds? It's really what's going to determine the overall performance. So let's look at what types of stocks that you can purchase, and then let's look at the characteristics of these stocks, because you can buy small companies, you can buy large companies, you can buy growth companies, and you can buy value companies. And so then it's looking at, okay, well, here, I want to make sure that I have all of these types of stocks in the portfolio, but then how much do I hold in each?
Well, that's right, and really you want international companies as well as emerging markets. So there's really a lot to consider here. But the point is, and a lot of you just pick one investment class, like the S&P 500. That's a common one, and that's a good one. I'm not saying that's not a bad one, but that's just one out of about 12 to 16 different asset classes that you're going to want to get into. And when you think about, let's say, growth funds and value funds, large versus small, they do have different characteristics, because smaller companies they're smaller companies, just like it implies, and they actually tend to have a little bit better rates of return, but they're more risky. And value over growth. Cheaper companies are value, growth companies are growing quickly, tend to be more profitable. The value companies tend to do a little bit better over time, but there's more risk. And Joe, when you kind of look at this graphically, I think that really helps you to figure it out.
Right. If you want to increase your overall expected return of the portfolio, here's what you need to take a look at. There's certain categories of stocks that are going to give you a higher expected return, because stocks are priced on risk. So if I look at, this is the entire market, and if I want to increase my overall expected rate of return, I want to make sure that, all right, I'm tilting my portfolio towards value in small companies. All right, I'm not saying put everything in small companies by any stretch of the imagination, or everything in value companies. But here, if you look historically over time, these have outperformed. Small companies have outperformed large companies. Value companies have outperformed growth companies. And the reason for that is there is more risk associated with those types of companies. Think about it. If you're a small company, let's say that I'm opening up a garage and I need some capital. So I'm going to go to you, the investor, and say, hey, you know what? I'm going to start a small company. Would you please invest $200,000 of startup capital so I can invest and build a garage, and I can do car washes, Jiffy Lube, or oil changes, or whatever the case may be? You're going to say, Joe, I would love to give you that $200,000, but I want 40% of your company. I'll be like 40% of my company, but that's my cost of capital. My cost of capital equals the investor's expected return. So let's say I don't open up one garage, I open up 50 garages and I have $10 million of revenue. You're going to make a lot of money because you own 40% of my company. If you give $200,000 to Google, which is a very large company, they're not going to give you 40%, right? They're going to give you 400th of a trillionth of a percent. So if I'm looking at constructing the portfolio, I want to make sure that I have different asset classes that I can get a higher expected return in the overall market just looking at the risk characteristics of the stocks that I'm buying. It doesn't make any sense to time markets or pick individual stocks, such as, hey, I think that pharmaceuticals are going to do very well because of the new healthcare bill because everyone has insurance. It's already priced in the market. You're not the only one that has that information. The whole market has that information. So when you're constructing your portfolio, just keep this graph in mind, making sure that you do have a little bit of money in small companies and value versus just the big, large growth companies that everyone knows. The Apples, the Microsofts, and so on.
Yeah, and you really do need to make sure you've got some of each. And Joe, that was a pretty good explanation. And really, we're not saying to go all small companies and all value, even though they tend to do better over the long term. The reason you don't want to go all in is they're also more risky. They're more volatile. It'll be more of a roller coaster ride. You really want some of each. But you want to make sure you have a slight tilt to small and value companies because your portfolio will do better over the long term. You also want to consider tax management, which simply means where are your assets located in terms of our retirement accounts, non-retirement accounts, maybe you got some Roth IRAs. Where those assets are located are going to affect how they're taxed. And Joe, that's another big miss that people are making is they're forgetting the tax component.
Right. Here's the problem. If you look at the taxation of the dollar, okay, if I can reduce the taxes on my income that I'm receiving for retirement, I can take less risk. And that is key when I'm trying to create retirement income. So we've seen this before. If you first-time watcher, here you go. You got tax-free dollars. That would be a Roth IRA. So every dollar that comes out of that account, you don't pay any tax at all. That's ideal. Then you have a taxable account, which is subject to a capital gains tax, which is right now 15% for most people. And then your tax-deferred assets, your retirement accounts, your 401ks, IRAs, all of these dollars come out as ordinary income. So when you're constructing a portfolio, okay, so then you have to look at the tax management of things. It'd be ideal if all of your money was sitting here because you never pay tax on any income that you're trying to create, but that's usually not the case. What we see is that all of the money is sitting in tax-deferred accounts, and every dollar that comes out of there is taxed at the highest of rates of ordinary income. But here's the catch, is that if I want to have real estate, CDs, things like that in the portfolio, bonds, I want to make sure that I hold them in my tax-deferred assets. If I have high flyers, if I want to invest in stocks, okay, such as smaller companies or value companies, I probably want to hold those over here because I could tax manage those effectively. Because as stocks go up, I'm going to pay a lower tax. If stocks go down, there's something that's called tax loss harvesting. There's a lot of different key areas. I just wanted to point this out again to make sure that you're not forgetting about the tax. Here's the deal. Come into our office, sit down with one of our certified financial planners. We're a fee-only financial planning firm. Absolutely no charge to take a look at your portfolio, to see how it's constructed, to see how you're tax managing everything. It's absolutely no cost. Here's the number, 888-994-6257. Call that for a free financial assessment with a board-certified CFP advisor or a CPA. We got to take a break. When we get back, I want to get into rebalancing your portfolio. How do you buy when stocks are low? How do you sell when stocks are high? How do you do this? That's what you should be doing. Most people don't do it, so don't go anywhere. Show's called Your Money, and it's Your Wealth. Hey, welcome back. You're watching Your Money, Your Wealth. My name's Joe Anderson, certified financial planner with Big Al as well. We're talking how to invest your overall capital. A lot of different things that you can do with your money. You want to make sure that you do it right. We're giving away a free book, Invest Like Warren Buffett as well. You can go to the website. But I think let's just check your knowledge. We do true and false questions at the break. Let's just see what you guys did here.
Okay, here we go. If I sell a stock at a big loss, I generate a capital loss on my tax return, but I can't deduct that loss against the sale of my rental property. And that is absolutely false. A lot of people don't realize if you sell a stock at a loss outside of your retirement account, that's the key, that loss shows up on your tax return and you can utilize that against any other capital gain, dollar for dollar. So a stock loss does actually net against a real estate gain. And for some of you that have rental properties and want to sell them but are afraid to pay the tax, you may have some loser stock positions in your portfolio, not because you tried to, but just because that's the way the market goes sometimes. You can sell that position, utilize that loss against your real estate. So that is available. And that's a big deal in saving taxes.
Right. I mean, again, you want to make sure that you're taking a look at taxes in regards to your overall investment strategy. So we looked at a couple of different things. First of all, you want to make sure that you invest globally. A lot of you are particularly, what we see is that you're just invest in the U.S. domestic markets. Large company growth stocks, buy what you know. That's what Peter Lynch always said. The rules have changed. You want to make sure that you have a globally diversified portfolio. Then you want to look at, well, how much money that you have in stocks versus bonds. And then in that portfolio, then you want to make sure that you have different categories of stocks. Because I have growth companies, large growth. Then I have some smaller companies here. Then I have value. I want to increase my overall return by tilting that portfolio a little bit more towards value companies and a little bit more towards smaller companies. Then we looked at the tax situation. All right, well, where are you holding your assets? If everything is sitting in your tax-deferred account, such as your 401k plan, everything comes out of there at the highest tax rates. So you want to look, hey, I want to make sure that I have some tax-free dollars or taxable dollars. Al just said this, all right, if I have a stock loss and real estate gain, can I offset those two and pay zero tax? The answer is absolutely. That's why you want to make sure that you're looking at your taxes in regards to your overall strategy. Here's another big thing. So when you look at investing, when should you buy? Should you buy high? No, you should buy what? When the markets are low, okay? But people do the exact opposite because of emotions. When the markets are very high, all right, the markets are going up. I feel really good. This is when I want to buy. And then when the markets do this, well, I don't feel very good. This is when I want to sell. That is the opposite of what you want to do. You want to be sure that you're buying here and then selling here. How you do that is just real simple. It's called rebalancing your portfolio. I'm just going to give a real simple example. I have 50% stocks and then 50% bonds. So now the market has increased. Instead of having 50%, now my portfolio looks like this. I have 60% in stocks and 40% in bonds. Well, that means I'm out of balance. What I want to do is make sure then, here, I have too much weight in stocks. So I want to sell my stocks, buy more bonds, so I get back to the 50-50. If you rebalance your portfolio, you're always buying and selling at the right time. It's a real big deal, and if you do this correctly, you're going to add tens of, not hundreds of thousands of dollars over your lifetime, and then when markets crash, your recovery time is going to be that much quicker because you're buying more shares of stock when the markets are low. They will correct. We just don't know when. Is it going to be tomorrow, next year, 5 years from now? Who knows? But make sure that you have the appropriate strategy. Al, a couple more things that we want to get into before we get out of here today.
Well, we do, and the next category I would say is not all investments are created equal. And certainly you could buy an individual stock. That would be one way to buy a position, but we don't think that's a good idea because you need diversification. You should buy a fund, a mutual fund, index fund, ETF, that has many stocks for that diversification. But those different kinds of investments are not created equal. Some have high costs, some have low costs. And when you look at what some of those costs are, some have initial costs to get in. That's called a load fee. Many and all have internal costs, and then some have back-end charges. And if you just take a look at what some of these different kinds of investments, the low-cost investments tend to be index-type funds and ETFs, exchange-traded funds. Medium cost would be retail mutual funds, kind of in the middle. And the most expensive investments tend to be annuities and non-traded REITs. And if you just look at the cost component alone, you kind of want to stay away from those higher cost investments and stick to the lower cost investments. That's not the only thing you got to consider. It's the other components that we talked about. But cost is very important because you don't want to give up your profit to someone else.
Right. In today's environment, if you take a look, if I'm paying a load of 5% and I'm paying 2 or 3% internally, that's money going to Wall Street instead of you. So if you look at, all right, if I have the proper diversified portfolio, I'm globally diversified, I'm tilting the portfolio more towards asset classes that are going to give me a higher expected return. If I make sure that I'm looking at the tax components of all of my investments, I rebalance the account, and then finally, I pick the lowest cost possible. That is going to add a lot more wealth to the bottom line. If you want, let's put all this together. A couple of things that I'm going to do. If you ever want to go to a retirement planning course, I teach a retirement planning course all over Southern California. You can go to yourmoneyyourwealth.com if you want to take advantage of that. It's 6 hours. Everything that we just crammed in a half an hour, I try to educate you and teach you on doing the things right with your money in a 6-hour course. We do 3 hours one night, and then we conclude 3 hours the following night. Go to yourmoneyyourwealth.com and check it out. You can look at, all right, well, when's the available classes? Is it anything near you? I would guess that I'm probably teaching somewhere near you. It's usually 3 nights a week. I'm out and about trying to educate you. If you want to come into our office and say, you know what, I need some help, I would like to sit down for a second opinion, use it as a sounding board, just call our office, 888-994-6257, 888-994-6257. Go to yourmoneyyourwealth.com. Hopefully you enjoyed the show.
It was fun. I can't wait for next week.
So join us next week. We got a lot more to go. Go to our website, Your Money, Your Wealth. For Big Al Clopine, I'm Joe Anderson. Have a wonderful weekend.